Is NASSCOM being realistic or is NASSCOM being optimistic? Let's discuss that with Anil Chanana, CFO with HCL Technologies, a stock which has got absolutely re-rated in the last 2 years. Anil, I guess my introduction was the question in itself. Is NASSCOM being realistic or are they being optimistic?
I think it depends upon company to company how it performs. And we have, even when the industry as a whole grew at lower rates, we have grown at the upper quartile of the industry growth rate. And we continue to, our strategies are directed towards that.
Before we talk about your business strategy going forward, just a news update, the pact that you signed with Linedata, what's the purpose with the Transfer Finance Business Center at this point in time?
So in early 2008, we had acquired Capital Stream, which came with a product, and that product we transformed in this period and grown that product. The size of the revenues there, we derived some 30 million revenues from that product in the last year. However, we have declared our strategy to be partnering with the product companies. So as part of that strategy, we have decided to divest this product, but at the same time retain the product development business, which we will do for Linedata as well as for other product companies. So we stay focused on our services business.
Anil, if I use the word guidance, I am sure you will knock your head, and I know your stated policy that you don't give a guidance. So how does one judge that you will grow for this year? Do you think what NASSCOM has indicated, that is the industry average, and you will continue to grow higher than the industry average?
I think whether one will grow or not grow, it depends upon the service offerings and the revenues mix. So we believe we have the best service offerings and we have the best revenue mix. So we have a service offerings oriented towards run the business, helping our customers run their operations. So in the course of assisting our customers run their operations, now we are also getting into change their operations. So most of the deals we sign with our customers are integrated deals. So here the customer comes, help me in transforming this application or this platform and run it for me, or maintain for me, or deliver business services for me. So the type of the services we offer are unique. We offer from engineering R&D services to package implementation to PPO services. So one has to see with reference to the type of services, the growth. And we have demonstrated in the past that we have grown at the upper quartile of the industry growth rate. So that should be a sufficient without referring to the numbers.
So you will beat the NASSCOM guidance. I'm not putting word in your mouth, but I'm just trying to judge in between your comments. A pause means yes, a pause means no.
We don't give any guidance. We have a business.
Fair point. Let's understand the environment. Do you think the current calendar year, which is 2013, will be a better year than 2012?
See, even the calendar year 12 was very good for us. We demonstrated 13% Y-on-Y growth. So if you look at is the segments where we are playing. So we are playing in that renewal segment. We are playing in the transformational segment. So we have the right service offerings available, and we are seeing the conversations happening in the marketplace for services like analytics, like mobility, like social, and we are participating in that. So when we are working with our customers in reducing their cost base, we are at the same time helping them use those savings in newer service offerings and help them in increasing their revenue base. So earlier we were working with the IT side of the budget, and now we are moving towards the marketing side of the budget. So we're working with the chief marketing officer in sort of helping him grow his business, grow his company's business.
Right. But what about, the core business? I mean, do you see improvement in demand? Your peers have been hinting at clients opening up wallet. Is that your experience as well? Or what about discretionary spend? Are you seeing signs of pickup there too?
In fact, we are doing a lot of discretionary spend, but discretionary varies in each of the areas. So when you talk about discretionary in the enterprise side, which is more of a greenfield implementations, it is we are yet to see the proof there. When you see the product development, we do see product development happening for the emerging markets as well as otherwise. When you talk about discretionary in our customer base relating to cloud, mobility, yes, it is happening because that's what we do as part of our total IT outsourcing or infrastructure managed services.
Final question, operating profit margins. Now, whereas you're growing at a run rate which is much higher than the industry average, your margins exactly are not highest in the industry. When do we see that happen? When will I get that quarter when I will thumb the table and say, brilliant margins, HCL Technologies has reported margins higher than the industry average?
So in this period of last many years, we have at least 2-3 years, we have also demonstrated a higher margins, an increase in margins, consistently increase in margins. We do believe that a margin range at EBIT level of 18 to 19% is sustainable in both the short as well as the medium term. However, it could vary from quarter to quarter depending upon any investments which are needed. So it basically follows the same philosophy that we want to retain a mix of services which are unique, which are more balanced. If you look at our stream of revenues, they provide more visibility. They are more longer term, more annuity-based revenues in our business, which have increased over a period of time and have helped us in improving our margin profile as well.
Right, Mr. Janana, thanks very much for joining us and giving us your perspective on the business. Appreciate your time this morning.